BlackRock's BUIDL integration, the first live liquidity bridge hook everything you've read about the BlackRock Circle deal, is looking at the wrong layer. This isn't a crypto partnership or a stablecoin story. It's the first live liquidity bridge connecting Treasury collateral to a settlement rail that never closes. The fund now holds over $1.7 billion, and major trading venues already accept it as collateral. Most coverage misses what this means for the financial system underneath, and where the hard limits still sit. Cold open plus framing. Most headlines treated the BlackRock Circle announcement as another crypto adoption story. BlackRock likes stablecoins. Circle gets institutional validation. That reading misses what actually changed. BlackRock's USD Institutional Digital Liquidity Fund isn't a crypto product. It falls into the same category as conventional money market funds that hold cash, treasury bills, and repurchase agreements. These are the same instruments that sit at the center of institutional funding markets. What makes it different is that ownership is recorded as tokens on public blockchains, starting with Ethereum and now extending to Solana, Arbitrum, Avalanche, Optimism, Polygon, and Aptos. Securitize acts as the transfer and tokenization agent. That means they handle investor onboarding, compliance checks, and wallet whitelisting. Only approved institutions can hold BUIDL tokens. This isn't a retail token you can buy freely on an exchange. You need to go through the full process first. It's a regulated fund wrapped in programmable rails. The scale signal matters. When BUIDL launched in March 2024, it carried a $5 million minimum investment. Within 2 years, assets crossed $1.7 billion. Major derivatives exchanges now accept BUIDL as collateral. BlackRock listed it on Uniswap in February 2026. That isn't the behavior of a side experiment, it's the behavior of core infrastructure. Circle's smart contract turns this from an interesting fund into something structurally new. It allows whitelisted BUIDL holders to deliver their tokens to Circle and receive USDC in return. The process is designed to be near instant and available around the clock. On a Sunday at 3 a.m., an institution can convert Treasury-backed fund shares into dollar-denominated stablecoins without waiting for a bank to open or a settlement cycle to clear. So the real question isn't whether BlackRock likes crypto. The real question comes down to what happens when a trillion-dollar asset manager starts moving collateral at the speed of information, and what the boundaries of that system still are. Part 1. The Legacy Trap. To understand why this matters, you need to see how collateral moves today and where it gets stuck. Repurchase agreements, or repo, are the oil that keeps institutional markets running. A dealer sells a treasury security to another party and agrees to buy it back later at a slightly higher price. Economically, this works like a collateralized loan. The treasury serves as collateral, and the cash serves as short-term funding. Dealers use repo to finance their inventories. Asset managers use it to borrow or lend cash. Derivatives desks use treasury collateral to post margin. The same security might be pledged multiple times across different markets in a single day. That mobility is what makes the system work. The problem is that the settlement rails underneath were built for a different era. Most transactions still run on a T+2 cycle. You agree today, but the security and the cash don't actually move for 2 business days. Cutoff times and batch processes limit how fast collateral can be reused. If a dealer needs to post margin at 5 p.m. on a Friday, the underlying treasury collateral is effectively trapped until Monday morning. That gap isn't a minor inconvenience. It creates a structural cost. Institutions maintain larger liquidity buffers than they would need if collateral could move continuously. The friction shows up in funding costs, margin requirements, and balance sheet efficiency. This isn't a problem that only crypto advocates care about. HQLAX, a distributed ledger collateral management platform, has built live systems with major banks specifically to reduce this friction. JP Morgan's Onyx platform and its tokenized collateral network launched in 2022 to let banks mobilize tokenized assets in financing trades using smart contracts. The Bank for International Settlements and the European Central Bank have both published detailed reports on how tokenized collateral could affect central bank reserve demand, and the transmission of monetary policy. So the industry has been trying to solve this for years. BlackRock and Circle just happened to be the first to put $1 billion pool of Treasury exposure on public chains with a live exit into digital dollars. Part 2. The bridge mechanics. Now we need to look at what the bridge actually looks like under the hood. BUIDL shares are represented as tokens on public blockchains, not paper certificates in a custody vault. They exist as digital tokens on Ethereum, and now 6 other networks. Each token corresponds to a share in the fund, and the fund itself holds cash, treasury bills, and repo agreements. The value of each share tracks the net asset value of that underlying portfolio. Securitize manages the tokenization layer. When an institution wants to invest, they go through a full onboarding process. Know your customer checks, accreditation verification, wallet whitelisting. Once approved, their designated wallet receives BUIDL tokens that match their fund position. When they want to exit through the traditional path, the tokens are burned or transferred back, and cash moves through standard banking rails. The Circle integration adds a second exit path. A whitelisted BUIDL holder can deliver their tokens to Circle's dedicated smart contract and receive USDC in exchange. This process completes in seconds, not days. It works at 3 a.m. on a Sunday. It works on a holiday when the Federal Reserve wire system is closed. The Circle smart contract itself is the central mechanism. It isn't a manual over-the-counter swap. It's an automated contract that validates the incoming BUIDL tokens, checks that the sender is on the approved list, and releases USDC from Circle's reserves. You don't need to negotiate a price or find a counterparty. The conversion happens at the fund's net asset value, with Circle acting as the redemption agent and USDC issuer in a single automated step. That structure removes several layers of intermediaries that exist in the traditional redemption process. You don't need a transfer agent manually processing the request, a custodian moving securities between accounts, or a correspondent bank handling the dollar transfer. The smart contract handles the validation, the token transfer, and the stablecoin release as one continuous operation. Here's a real scenario. A global asset manager holds BUIDL as a liquidity buffer. They need to post dollar margin for an Asian derivatives position that opens Sunday evening. In the legacy system, they'd need to request a fund redemption, wait for processing, wait for the banking system to open, and possibly miss the margin window. With the Circle contract, they deliver BUIDL tokens, receive USDC, and move that USDC directly to the exchange's collateral. The entire sequence can happen in under a minute. That isn't a convenience feature. That's a change in the time dimension of collateral mobility. The multi-chain expansion is worth noting here too. After launching on Ethereum in March 2024, BlackRock and Securitize added share classes on Solana, Arbitrum, Avalanche, Optimism, Polygon, and Aptos. That signals an explicit bet that institutional activity will emerge across multiple blockchain ecosystems instead of one. BlackRock isn't treating this as a single-chain experiment. They're making the fund accessible wherever the market goes. But before this sounds like a finished system, keep one detail in mind. This bridge only works for whitelisted wallets. The Know Your Customer gate doesn't go away. The programmability happens inside a permission perimeter. That distinction matters, and we'll come back to it. Part 3, from T+2 to never closed. Now, keep that mechanism in mind, because here is where the implications stop being theoretical. In the legacy system, time functions as a structural constraint, not a detail. When a dealer posts margin at 11 p.m. on a Saturday for a position opening in Asia, the collateral they hold in New York is trapped. The settlement rails don't run on weekends. Custodians are closed. Wire systems are down. They either pre-position excess cash before Friday close, which costs them yield, or they miss the window. BUIDL with Circle integration removes that constraint. The collateral isn't trapped in a custody account waiting for Monday. It exists as a token on a blockchain that settles around the clock. You convert to USDC, move it to the exchange, and post it as margin. The sequence that used to take days now takes seconds. The evidence that markets are treating this as real infrastructure is already visible. Crypto.com, Deribit, and Binance accept BUIDL as collateral for derivatives positions. The Uniswap listing in February 2026 means BlackRock is treating on-chain liquidity as a core distribution channel, not an afterthought. When the world's largest asset manager lists a tokenized Treasury fund on a decentralized exchange, the signal isn't about DeFi culture. It's about settlement infrastructure. The regulatory context shifted in 2026 too, with the SEC publishing staff guidance on tokenized securities in January and the NYSE's receiving approval to trade them in April. These are signals that the market structure is shifting from asking whether tokenized assets should exist to figuring out how they fit into existing rules. That reduces one of the biggest barriers that has kept institutional capital on the sidelines. Compliance uncertainty is expensive. When the SEC, NYSE, and NASDAQ all start mapping tokenized instruments onto existing frameworks, the legal risk of participation drops. Not to zero, but meaningfully. That regulatory shift goes beyond a compliance detail. It removes the single biggest objection that keeps institutional capital from moving onto these rails at scale, which means the repo market implication is no longer theoretical. The first building block of a 24/7 collateral pipeline is now live. A Treasury-backed asset can be tokenized, accepted as margin, and converted into dollar settlement tokens on demand. That pipeline didn't exist 2 years ago. Now it holds over $1 billion and runs on 7 chains. That doesn't replace the tri-party repo market overnight. The volumes are still small compared to the $16 trillion traditional repo market. But the architecture is live. It's a system with real collateral, real counterparties, and real settlement flows. And that brings us to the boundaries, the part that most coverage skips entirely. Part 4, Boundaries and Risks. Permissioning forms the first boundary. BUIDL tokens only circulate between whitelisted wallets. You can't buy them on a public exchange without going through Securitize's onboarding process. The tokens are programmable, but the programmability is gated. That's a design choice, not a temporary limitation. It reflects how BlackRock and Securitize are navigating fund law and investor protection rules. The result is a hybrid of public blockchain rails and private access controls. Settlement finality creates the second boundary. The bridge flows into USDC, not into central bank money. USDC is a well-regulated stablecoin with audited reserves, but it's still a private liability. It carries issuer risk, regulatory exposure, and the operational risk of the smart contract itself. In a stressed market, the difference between a private stablecoin and a Federal Reserve liability isn't a technicality. It's a different category of safety. Regulatory clarity forms the third boundary. The SEC's January 2026 staff guidance and the NYSE's April 2026 approval are positive signals, but they aren't formal safe harbors. Staff guidance can change, and exchange rule approvals don't create new legal exemptions for tokenized funds. The compliance framework is evolving, which means institutions still face interpretation risk. Fragmentation creates the fourth boundary. BUIDL now runs on 7 blockchains, each with different smart contract implementations, liquidity profiles, and bridge risks. Moving collateral across chains introduces its own friction and security assumptions. The multi-chain expansion is a bet on interoperability, but interoperability at scale is still an unsolved problem. The Bank for International Settlements raised a deeper concern in its G20 report on tokenization. Tokenized collateral structures could influence demand for central bank reserves and change how monetary policy transmits through the financial system. Those effects aren't well understood. The BIS didn't say this is dangerous. They said it's unknown and that central banks need to pay close attention. So the boundaries are real. They don't make the bridge useless. They make it a production-grade proof of concept rather than a finished system. That distinction is worth making. Connection. What this actually means. Let's pull this together, because the full picture is where the signal actually lives. BUIDL is a conventional money market fund wrapped in tokens, not a crypto product. Circle operates as a settlement infrastructure provider that built an automated redemption rail, not a crypto partner. Together, they created the first live liquidity bridge between traditional Treasury collateral and a digital settlement layer that never closes. That isn't about crypto adoption. It's about the legacy financial system rebuilding its settlement layer using programmable tokens, because the old rails can't support the speed that global markets now require. HQLAX and JP Morgan Onyx are solving the same problem on permissioned ledgers. BUIDL is solving it on public chains with a systemically important asset manager. Both are experiments. Both are real. These parallel tracks are converging. Permissioned ledgers and public blockchains are both trying to compress the time gap between when collateral is needed and when it can move. The difference isn't ideological, it's architectural. Permissioned systems optimize for control and regulatory fit. Public systems optimize for reach and composability. BUIDL sits in the middle, using public chains with permissioned access. The regulatory shift in 2026 tells us the frame is changing. The SEC, NYSE, and NASDAQ aren't asking whether tokenized securities should exist. They're asking how to fit them into existing market structure. That's the question you ask when an innovation has crossed from experiment to infrastructure. The BIS called this a unified ledger vision, where tokenized securities and central bank money could coexist on the same infrastructure. The ECB's Pontes project is testing settlement in central bank money for tokenized transactions. These aren't fringe experiments. They're the largest financial institutions in the world redesigning the settlement layer. BUIDL is simply the first live instance at scale. It's a proof of concept with $1 billion behind it, and that makes it worth watching more closely than any price chart. Takeaways. If you're tracking this space for investment or analytical decisions, here are 3 things worth keeping in mind. First, watch settlement infrastructure, not price. The metric that matters is whether tokenized collateral is being accepted as margin and settlement by regulated and semi-regulated venues, not whether the token price moves. Acceptance as collateral is the signal that the infrastructure is becoming real. Second, regulatory clarity works as the real catalyst. The SEC staff guidance and NYSE rule change in 2026 reduced compliance uncertainty for institutions. That matters more than any product launch, because legal ambiguity is what keeps institutional capital on the sidelines. Third, the permission-public hybrid likely defines the path forward. Full permissionless access isn't coming to institutional repo markets in the near term. The model that works will look like BUIDL. Investors go through compliance checks at the door, and once inside, the tokens move on public rails with smart contract logic. Regulators get the control they want, and markets get the programmability they need. Neither pure decentralization nor pure traditional custody will win. The middle ground is where the infrastructure is being built. If this kind of structural analysis is useful to you, subscribe. This channel was built for exactly this type of research. The next frontier isn't more tokenized funds. It's whether central banks will allow settlement in central bank money on these rails. That's the question that will determine whether tokenized collateral becomes core plumbing or stays a parallel track. And that's what we'll be watching.